looks like the United States will enforce 25% tariffs on Mexican and Canadian imports starting from March 4. In addition, as of the same date, an extra 10% tariff will apply to goods from China. Given that China's imports have already been subject to a 10% tariff since February 4, this means the total duty will effectively reach 20%. Europe is also on this blacklist. The White House will impose 25% tariffs on the cars and everything else. Let me remind you that 25% tariffs on imported steel and aluminum are due to take effect from March 12. Washington is going to introduce so-called reciprocal tariffs on all countries trading with the US from April 2. By April 2, Trump promised to decide on whether to introduce 25% or even higher tariffs on imported cars, semiconductors, and pharmaceuticals. Naturally, every action by the US will be met with the countermeasures from its trading partners. Perhaps they might become trade adversary soon. Interestingly, the United States has already experienced a similar situation in history. In June 1930, President Herbert Hoover raised import tariffs by an average of 40%, and this triggered retaliatory measures from other countries, disrupted global trade, and complicated efforts to combat the Great Depression. We wouldn't like to draw such a comparison, but over the past week, the US stock market has already dropped by 5%. The Nasdaq recorded its steepest fall in months, while the S&P 500 erased all its gains since the beginning of the year. The US dollar is also suffering losses. Its six-currency index sank by 1% in February, and the main factor behind the fall was market concern about the stability of the American economy. As for the euro-dollar pair, the euro has long maintained its stability, largely due to the Donald Trump's tariff threats. Traders have grown so wary of reaching to the endless stream of White House announcements that they simply started ignoring them. Moreover, the Eurozone still hurls onto hope for reciprocal tariffs, which could partly ease the pressure on the euro from the US dollar. From this perspective, the forex outlook will clear up only in early March, once Mexican and Canadian tariffs come into effect. For now, it makes sense to watch the support test in the area of 1.0345 to 1.0355. A breakout in either direction will help determine whether to buy or add more short positions. Of course, traders should not lose sight of incoming economic statistics. For example, the weekly update on initial unemployment claims was 20,000 higher than the consensus. Besides, the inflation data published today matched the forecast. The annual CPI came out at 2.5%. However, investors are expressing fears about a possible deterioration in the economic situation. Brent crude prices are trading well below February's peak of $77 per barrel, fluctuating within the range of 72.50 to 73.40. Amid US threats to impose tariffs on its key trading partners, the entire February is closing in the red for the oil market. Trade wars commonly dent risk appetite in the global markets and dampen demand prospects for energy commodities. Over the past winter months, both benchmark crude grades, Brent and WTI, have lost more than 2.5%. Unlike oil, the ruble appreciated in February, and this was driven by two key factors: retail investors shifting funds into rubles and relatively high commodity prices. Analysts believe the bullish trend is not over yet. The recent uptick in the dollar within the range of 87.30 to 88.80 appears to be just a correction for now. Exporters are still selling foreign currency to pay dividends, and the Bank of Russia's interest rate remains very high, providing further support for the Russian ruble. So that's all for now. We continue to follow developments in the financial market. Subscribe to our channel and follow news with us. We wish you profitable trading and have a nice weekend, and see you on a Monday.